Welcome to Canada Pension Plan Investment Board's 2016 public meeting. My name is Tara Perkins. I'm Director of Stakeholder Affairs at CPP Investment Board, or CPPIB. Today we're broadcasting from Toronto to bring together Canadians simultaneously from coast to coast in 9 cities across the country and on our website. This webcast allows us to make the meeting available to those who are unable to attend in person. We hold public meetings every 2 years to speak directly to you about how we are managing the CPP Fund and allow you to ask our senior leadership questions. But we're also happy to take your questions any time of year. The best email address to reach us is contact@cppib.com. So here with me today in Toronto are Heather Munroe-Blum, Chairperson of our Board of Directors, our current President and Chief Executive Officer, Mark Wiseman, and our incoming President and Chief Executive Officer, Mark Machin. Heather Munroe-Blum and Mark Wiseman are going to provide an update on CPPIB's recent activities as well as some background about the organization. Mark Machin will conclude with some brief words on the future of CPPIB. There will be time after the presentation for a Q&A, and you can submit your questions by speaking directly to the CPPIB representative at your location. Just fill out a question card and hand it to them. Or if you're joining us via the web, simply type your question into the comment box on the screen. Before we begin, we have a video to introduce you to CPPIB.
In Canada's early history, most seniors depended on their savings or families for retirement income. To ensure Canadians had a basic financial foundation for their retirement, the federal government introduced the Canada Pension Plan, or CPP, in 1966 as a mandatory savings plan financed by employer and employee contributions. At that time, all benefits depended exclusively on current contributions. This model worked well when there was 6.5 workers for every retiree, and lifespans were such that the typical career was longer than a contributor's retirement. But by the mid-1990s, it was clear change was needed, as a dwindling Canadian labor force struggled to support an aging population. This problem was only getting worse. Projections indicated the ratio of workers to retirees would shrink further and Canadians would live even longer. Without changes, the CPP would run out of money. To ensure it would be there for future generations, the federal government and provinces agreed to substantial reforms. They increased contribution rates and created an independent investment manager that was accountable to government and the public, called the Canada Pension Plan Investment Board, or CPPIB, to generate long-term investment income to help pay benefits.
The CPPIB has a single mandate to invest the funds that come in from contributors to maximize return without undue risk of loss. We have a deeply engaged board of individuals who bring a wealth of experience from global operations to investments to business to the highest standards of corporate governance. The Canada Pension Plan Investment Board Act guarantees the independence of CPPIB to act according to its mission. The independence of CPPIB from political influence is absolutely critical to allowing the investment professionals to perform their duties.
CPPIB diversifies, first amongst the type of assets it invests in, which include public and private equities, bonds, infrastructure, and real estate, to enhance potential returns and reduce overall risk. With Canada only representing approximately 2.1% of the global economy, CPPIB invests in countries around the world to benefit from global growth and to reduce the fund's dependence on returns from any one country, currency, or region. And most importantly, CPPIB looks at investment opportunities over decades instead of quarters. This long-term focus means the fund will lose money in certain years, but will increase in value over multiple generations. This opens the door to a wider variety of investment opportunities. CPPIB has built a global network to access these opportunities, with offices and personnel on the ground around the world.
In order to be successful, in my view, any great investment organization needs a clear and cogent strategy. We have to realize that as a fund which is exposed to the market, equity markets, bond markets, and private markets, that the fund will have years where it goes up and the fund will have years when it goes down. Our job over the long run is to deliver the best risk-adjusted returns that we can. It's those long-run returns that ultimately matter in terms of the sustainability of the Canada Pension Plan. In fact, to date, if you look at the value of the fund, substantially more than half of it is, in fact, due to investment returns, not contributions.
Every 3 years, the independent Chief Actuary of Canada reviews the financial state of the CPP Fund. The review considers many factors, including increases in life expectancy, immigration, and the rising number of retirees relative to workers, and their impact on both benefits and contributions. The latest report confirms that the CPP Fund remains financially sustainable for at least the next 75 years, assuming an average 4% return. CPPIB's return since inception is comfortably above this required benchmark.
CPPIB's strength lies in its people, our purpose, our culture, and our commitment to our guiding principles, which have allowed us to attract and retain the very best people. We know we're working for you, our contributors and beneficiaries. The Canada Pension Plan needs to be there, not just for us when we retire, but for our children and our children's children when they retire. And we're proud of the privilege that we have, day in and day out, to invest on behalf of Canadians.
To learn more about CPPIB, including its performance and investment holdings, please visit cppib.com.
So I hope you found the video informative, and with that, I'm going to hand it over to Heather.
Thank you, Tara. Hello and welcome, everyone. This year is the 50th anniversary of the Canada Pension Plan. While CPPIB only began to invest the CPP Fund more than 3 decades after CPP's establishment in 1966, we are well on our way and take very seriously the responsibility to help ensure the CPP celebrates its centennial. I'm very pleased to be here today on behalf of our Board of Directors to provide background on our governance and oversight of this organization. The CPP Fund assets belong to you, the 19 million contributors and beneficiaries who participate in the CPP. It's been an exciting and busy year for the Board, overseeing the prudent and gradual evolution of CPPIB's investment framework and the recent appointment of CPPIB's 4th CEO, Mark Machin. Mark has been instrumental in shaping and executing CPPIB's strategy over the past 4 years, consistently demonstrating deep knowledge of our business, understanding of our global opportunities, and a commitment to our unique mandate and culture. With an impressive depth of senior leadership talent within CPPIB, the Board unanimously agreed that Mark Machin was the ideal choice to lead the organization through the next chapter of the mandate. While Mark Wiseman leaves big shoes to fill, the Board of Directors is confident that Mark Machin will do so in an impressive fashion. The Board is very grateful for Mark Wiseman's long and dedicated contribution to executing the CPPIB mandate. We are proud of his accomplishments during his 11 years with CPPIB, and we wish him continued success in his new role. On behalf of the Board, thank you, Mark. While our leadership has changed, our active strategy remains the same. We continue to focus on ensuring that management is pursuing a strategy that will deliver the best risk-adjusted returns for you. We measure their success not by quarterly or yearly indicators, but by the long-term value they're able to create to ensure that CPP is there for the generations to come. As the video mentioned, the Independent Chief Actuary of Canada projects that the CPP Fund will need a 4% real rate of return in order to be sustainable over the next 75 years. Our goal is to ensure that we meet or exceed this target without taking excessive risk. Mark Wiseman will explain how CPPIB is meeting that goal through our prudent approach to investing. With that, over to you, Mark.
Thank you, Heather. Since I last reported to you during our previous public meeting in June 2014, the fund has grown by nearly $60 billion. CPPIB contributed just under $50 billion in net income, with the remaining $10 billion coming from net contributions to the Canada Pension Plan. During that same period, we completed approximately 300 global transactions, 100 of them over $200 million, and we did this in over 15 countries around the world. As Heather noted, CPPIB is focused on growing the CPP Fund to help ensure the continued sustainability for our contributors and beneficiaries. What we found as an organization is that this goal can't be judged on a quarter-by-quarter or even year-by-year basis. We are not only investing your funds, we also need to look forward to beneficiaries who haven't even been born. That's why we judge our results over decades. The CPP Fund started with just under $45 billion in government bonds back in 1998. And this has grown to nearly $280 billion today. Our current 10-year real rate of return is 5.1% after all costs, and this is comfortably above the required 4% real rate of return. Over half of the total value of the fund, or nearly 58%, is the result of the investment returns over and above your contributions. We never expected that the road to achieving these results would be straight and linear. By design, we are expected to be exposed to capital markets in order to achieve higher returns over the long term. That necessarily means taking on prudent investment risk and exposure to volatility. The fund's 10-year result includes the 2008 recession, for example, which resulted in an annual loss of 18.8%. We can also see this volatility in our financial results over the last 2 years. Despite one of the more challenging investment environments in recent times and predominantly negative stock market performance, we generated a moderate 3.4% gain this past fiscal year. We can contrast that with our fiscal year 2015, where we achieved our highest return ever of 18.3%. None of these years taken in isolation are important, whether positive, negative, or neutral. Achieving value over decades is what matters to the CPP Fund. Volatility is both expected and necessarily incidental to our prudent strategy, which is to grow the fund over multiple generations. Indeed, we expect to incur losses of at least 11% 1 year in 10. But over time, we expect to achieve superior long-term returns given our risk-return profile. And this is appropriate for an extended horizon like we have at CPPIB. For the rest of my presentation, I'm going to focus on the strategy that we use to achieve these results. 10 years ago, CPPIB made a strategic decision that fundamentally changed how we invest the CPP Fund on your behalf. We moved away from passively managing the fund's investments to pursue an active management strategy. That is, instead of passively investing in government bonds and portfolios that simply mirror global stock market indices, such as the TSX or S&P 500, we decided to actively choose our investments in public markets and to invest in things like real estate, infrastructure, private equity, credit, and even farmland. To judge the results of our active management strategy, we compare our investment returns to a reference portfolio which is comprised of those market indices of bonds and equities. In other words, we compare our active management results to the passive investment option that we chose not to pursue a decade ago. Using this simple metric over the last 10 years, our active management strategy has contributed $17.1 billion of investment income after all costs. And this is equivalent to 80 basis points per year in excess annual returns, in comparison to what we could have achieved had we just invested the portfolio passively. In addition to this $17.1 billion in increased value, we believe that the CPP Fund is much more resilient and can better withstand risks because it is so highly diversified by both asset class and geography. We witnessed this in fiscal 2016. In this year, our private assets served as a safe harbor from the rough seas of the public markets. This strategy is reflected in the assets that we own on behalf of Canadian workers and retirees. We continue to build a diversified portfolio of assets designed to provide strong returns through market cycles over a long investment horizon. CPPIB invests globally across a wide range of asset classes, including public equities, bonds, private debt, real estate, and infrastructure. For a fund of this size, fulfilling CPPIB's mandate requires us to pursue international investment opportunities. The centers of economic and demographic power are shifting around the world. For example, over the next 2 decades, China is expected to overtake the United States as the world's largest economy. And India's economy recently surpassed Canada's in terms of overall size. To reduce an over-reliance on Canada's relatively small capital markets and domestic economy, CPPIB has diversified risk internationally and harnessed the power of global growth for the benefit of Canadians here at home. Today, Canadian workers and retirees, through the CPPIB, own assets all over the world, including shopping centers in Brazil, office towers in New York City, shipping and distribution hubs in Asia, and toll roads in Chile, just to name a few. At CPPIB, we are competing against the largest and most sophisticated investment companies around the world for these assets. In order to effectively do so, we need to invest in the talent, systems, practices, and structures that are necessary to succeed. We have built a global organization headquartered in Toronto with offices in New York, London, Hong Kong, Mumbai, Luxembourg, and Sao Paulo. Expertise in these international locations provides CPPIB deep insights, connections, and access to investment opportunities that simply would not be available if we did not have that local presence. While we continue to add skill and talent, we also remain vigilant in managing the costs that we incur to ensure that they are adding value for you. Our culture dictates that no dollar is to be spent unless it goes to work to create more dollars for Canadians. In closing, I want to thank all of CPPIB's employees for their ongoing dedication to building the foundation for Canadians' financial security in retirement. Leaving CPPIB was an extremely difficult decision for me, and one that I deliberated over very carefully. CPPIB is an exceptional, enduring institution. The opportunity to serve CPPIB for over a decade has been a great privilege. It will remain the greatest highlight of my career. Now, having worked closely with Mark Machin, my successor, for several years, I have complete confidence in his ability to assume this role without missing a beat. I believe that Mark Machin has all of the skills to lead CPPIB through the next chapter of its evolution. And with that, I will turn the floor over to our incoming CEO, Mark Machin.
Thank you, Mark. It's a remarkable honor to have been selected by the Board of Directors to lead this outstanding organization. I'm mindful of the fact that Canadians trust CPPIB with their money and are counting on us to help ensure that it's there for them in their retirement. This is a major responsibility and one that I assume with great respect and commitment. And I'm particularly pleased to assume the helm at a time when CPPIB is playing an increasingly important role globally on your behalf. CPPIB is really well positioned to find, secure, and manage the very best investments around the world. And I look forward to working with our Board of Directors, our employees, and Canadians to help make sure that the CPP continues to be on a solid financial footing for generations to come.
Thank you, Mark. We hope that you found today's presentation informative. You can review it on our website anytime at cppib.com. We're now going to move into the question and answer period. Some of you have already submitted questions, either through our website or at the meeting you're attending, and we're going to start with those. But you can keep sending in questions for either Heather Munroe-Blum, Chairperson of our board, Mark Wiseman, our Chief Executive Officer, or Mark Machin, our incoming Chief Executive Officer. To remind you, if you're attending the meeting in person at one of our public meeting locations, submit a question by filling out the question card and handing it to the CPPIB representative on site. They'll submit your question to us here in the Toronto studio. If you're joining us via the web, simply type your question into the comment box. We're going to try to cover as many questions as we can today, but due to time constraints, we're probably not going to get to all of them. Any that we can answer today, we will respond to in writing after the meeting, as long as you've provided your contact information along with the question. So let's get started. Our first question is going to be for you, Mark Wiseman. It comes from Hamish. It's about climate change, and it's fairly long, so I'm just going to read it directly. A number of the world's largest public pension funds have described plans to align their investment strategies with greenhouse gas emissions reduction targets and the low-carbon energy transition agreed to by 195 countries in Paris last year. In light of comments on climate change-related investment risk by the Financial Stability Board at the G20 and the former Governor of the Bank of Canada, Mark Carney, members would like to know how the CPPIB team is working to address climate change issues across asset classes.
Thanks, Tara, and thank you, Hamish, for the question. At CPPIB, we have to look at all risks in our portfolio, and certainly risks associated with climate change are particularly important. Those risks are very important to any investor, but for CPPIB, they're even more important for us to take into account given the long-term nature of what we do. As I've said in the past, we're not investing for a quarter that's 90 days. We're thinking about a quarter as 25 years or more. As it relates specifically to issues around climate change, we look at this from both a top-down and a bottoms-up point of view. From a top-down point of view, we address this issue, in fact, by looking at it from the total portfolio. What is our actual exposure? And we've recently set up, for example, a special climate change working group across all of our asset classes that tries to better assess and measure how much exposure we have in terms of the value of the fund. We also look at it from a bottoms-up approach. Each and every investment that we make, one of the things that we look at is what will be the long-term impact of climate change on that investment. And again, it creates both a cost to us and an opportunity in the way that we invest. And finally, I'm delighted that you brought up the work that the FSB, the Financial Stability Board, and Mark Carney are doing in this area. And I'm very pleased to say that CPPIB has recently had one of our employees, in fact, our head of sustainable investing, Stephanie Least, appointed to the FSB's working group on climate change. And we're one of only two global institutional investors, ourselves and the Dutch fund PGGM, who have been asked to join that committee of the FSB. So we think it's really important. We think we have to continue to follow this very, very carefully. And as a long-term investor, these issues are important, not just from a social point of view, but from our perspective, very important in terms of the long-term value of the fund.
So we're receiving a number of questions on climate change, so let's take another. This comes from Ruth. She's watching us on the webcast from Dundas. Mark Wiseman again, she says, what actions are you taking with regard to the carbon bubble that is imminent as fossil fuel companies suffer lowered returns, therefore reducing the value of our pensions?
So again, Ruth, this is a very important question, and we have to assess all risks in the portfolio. So our job is to develop a very diversified portfolio across geographies, across asset classes, across currencies, and we want to ensure that we don't have too much of any one type of risk in the portfolio. And indeed, one of the important risks that we pay attention to is the carbon pricing risk in the portfolio. We've seen the effects of that even recently as oil has gone from $110 down to as low as about $26 US. And so we try and really understand how that risk is going to affect us economically, and we try and ensure that we are fully diversified, including, by the way, looking at it as the carbon bubble, as you call it, also looking at it as an opportunity for us. And it's one of the reasons, for example, why we're doing more investing in things like wind. Just one example, our investment in Puget Energy, which is a utility in Washington State. That utility has really moved away from heavy carbon producing electrical production, and we, as being one of the shareholders in that, have heavily invested in much more renewable energy. So we see the carbon pricing bubble, if it is that, as both a risk and an opportunity to the fund. And every investment we make, we ensure that we are integrating into that decision things like environmental, social, and governance factors. And again, our sustainable investing group, which sits not outside our investment teams, but as part of our investment teams, has input into every investment decision we make. And indeed, it's something we spend a lot of time thinking about.
So there was actually a second part to Ruth's question, and I'll ask this of you, Mark Machin, because it's forward-looking. Will the CPPIB bring its investment strategy in line with Canada's commitment to limiting global warming to 1.5 degrees Celsius?
Yeah, well, thank you, Ruth, again for the question. And I'll just add, as Mark Wiseman has just explained, we are taking action today, both top-down and bottom-up, as we look at all of our investments in analysing the risks. And we'll continue to do that, and we'll also continue to monitor new developments. And we'll evolve our strategy over time as new and better methodologies emerge, which will help us to evaluate the risks. And we'll keep contributors and beneficiaries informed as we evolve our strategy over time.
Okay. Our next question comes from John. He's watching us on the webcast. Mark Wiseman, this one will be for you. He says, with interest rates so low and projected to stay low, how will CPP meet its required return without taking on too much risk?
Thanks, John. That's a good question, and certainly something that all of us worry about, whether it's in your CPP portfolio, in your RSP, or in other parts of your savings. One benefit we have at CPPIB is that we look at the required rate of return that we have to achieve over the very long term. So, in fact, when you're looking at the 75-year time horizon that the Chief Actuary of Canada uses to determine that 4% real rate of return that we're required to deliver, we don't have to deliver that in any given year. We don't have to deliver that in any 5-year period or any 10-year period. So one thing that we're focused on in terms of setting the risk appetite for the fund, we're not setting that risk appetite based on any near-term market conditions. So even though we're in a low interest rate environment now, we're not taking on more risk just because we need to achieve some return over the short term. Similarly, we wouldn't bring down our risk appetite in a high interest rate environment. That's a huge benefit of being a long-term investor. As Mark Machin and I talked about this morning in a piece that we wrote for the Globe and Mail, at some level, the CPPIB is like a 29-year-old with a good income who never turns 30. So we can have a risk appetite that has reasonably high risk exposure, but we don't have to adjust that based on market conditions. We can look at what we expect to be the very long-term expected returns to various asset classes, including fixed income and equities. And that is something that frankly, sets CPPIB apart. A lot of other investors in this environment are having to reach for yield, reach for gain, crank up the risk dial to meet some rate of return that they require in the short term. We are not affected by that type of short-term behavior. And in fact, we're seeing a lot of behavior in the markets that's worrying as investors, in order to make some required rate of return, crank up, often without realizing it, crank up their risk profile in order to achieve some specified yield. So again, we take a much longer term approach. Low interest rate environments obviously make it difficult, and we also expect volatility as inevitably that trend reverses and that impacts markets, including negatively as it relates to things like equity and real estate.
Okay. Our next question is one we've actually received from numerous Canadians across the country who I assume are coordinated. It's going to be for you again, Mark Wiseman. Why did CPPIB spend $900 million to bail out Encana by buying its Colorado fracking operation, where local communities have been fighting plans to drill 15,000 wells? How is this acceptable?
Thanks again for that question. So again, our job isn't to bail out companies or to support any specific project, whether it's a public policy-based project or a corporate-based project. Our job is to deliver to you, the 19 million contributors and beneficiaries, a long-term risk-adjusted return that will sustain the Canada Pension Plan for you, your children, and your children's children in retirement. We do that by investing in a diversified way. In the case of the announced transaction with Encana, we are indeed contracted to purchase about $900 million of assets in the DJ Basin in Colorado. We've made the determination, based on a tremendous amount of due diligence and being very cognizant of the risks, including the regulatory risks, that asset will add overall to the diversification of the portfolio and will be part of the overall $280 billion portfolio that will deliver on that promise to Canadian contributors and beneficiaries. So we have no interest in supporting Encana or any other company in that regard. All we care about is delivering on that legislative mandate that's very clear, which is to maximize returns without undue risk of loss on behalf of all contributors and beneficiaries.
Our next question comes from Paul. He's watching us on the webcast from Nova Scotia, and he wants to know, what is the rate of return of CPP since January 1st, 2000, he says, to December 31st, 2015, so essentially a rate of return since inception?
So I don't have that exact number in front of me. I think if the dates are since inception, it's about 7.5%. So it depends on exactly which day you start with and which day you end on. But our nominal rate of return since inception, and that, by the way, is on a time-weighted as opposed to a dollar-weighted basis, is about 7.5%. If you look over the last 10 years, which is our active management, since the inception of our active management strategy, that rate of return is 5.1% real. That's 5.1% after inflation. And that's a really important number because that's the one that we compare to the 4% real rate of return that the chief actuary assumes the CPPIB will earn on the fund. And that's how we determine whether or not that 9.9% contribution rate is currently appropriate. So over 10 years, the real rate of return is 5.1%. I think, again, nominal, that works out to about 7.8% nominal, again, over the last decade. It's about the same over the since inception period on a nominal basis. It's interesting, the period that's chosen in the question, because it actually includes both the tech wreck in the early 2000s and the global financial crisis. And I think that's an important point. We can't look at returns on an annual basis. There will be fantastic years like we had last year or in fiscal 2015, and there'll be very tough years like we had in fiscal 2009. What we have to look at is what is that long-term sustainable number. And it actually relates to the last question on interest rates as well. It's that long-term return that matters. And if we had to manage the fund to annual returns, we'd have to manage it a lot differently.
Thank you. So our next question comes from June. She's watching us online as well. And this is probably a question for government, but let's ask it. Mark Wiseman, realistically, hundreds of thousands of Canadians die before they reach their retirement years, having made contributions to the CPP for 20 or 30 or 40 years, and they don't have beneficiaries. Where or what happens to these funds?
Well, June, we have the relatively easy task here at CPPIB of managing the reserve fund for the Canada Pension Plan. The Canada Pension Plan itself and its policies, including eligibility and so on and so forth, is determined by the federal and provincial government. So we have a sole job, which is to manage the assets, and we don't set the rules for eligibility. We don't mail out the checks, and indeed we don't set the contribution rates or benefit levels. So that's a question that is best asked of your MP or a member of your provincial legislature, because indeed it's the federal and provincial governments that make those types of decisions. The one thing I will say that is interesting about the CPP is the way that it's been set up. And again, this isn't CPPIB that does this, but it's worth pointing out, since there is a big debate going on in the country today about potential reform of the Canada Pension Plan. Again, a debate we're not part of. But the CPP, as a part of policy, does look to what we call mutualized longevity risk. So it is, in fact, a way to protect contributors and beneficiaries from living for a very long time, and that you continue to receive your benefit no matter how long you live. On the other hand, if you die young, you, of course, don't receive the same amount that you may have paid into the system. And that's how the plan was designed. That was a choice that was made actually back in 1966. It was reaffirmed in 1997. That may be a choice that policymakers can look at again, and those policymakers are your provincial and federal members of Parliament. And I encourage all Canadians to get involved in the very important debate around the potential reform of the Canada Pension Plan.
Okay. Our next question comes from Jane. She's in Victoria. She wants to know, how do reports from human rights organizations inform our investment decisions? Does your sustainable investing group consider human rights information that's available in each country before making an investment decision? Mark Wiseman.
Thanks, Jane. Another really good question, because, of course, human rights, working conditions, labor rules, all of these types of issues are indeed something that we think about and integrate into our investment decision-making process. So again, we think in the long run, these types of issues will go to the value of our investments. We think that companies that don't do a good job managing their supply chain, looking at issues like managing working conditions, treating workers appropriately, not just in terms of wages, but also occupational health and safety. We think companies that do a poor job at those things will be less valuable, especially in the long run. And as a long-term investor, we integrate that into our decision making. So indeed, we review reports from human rights organizations and other NGOs. We're happy to get information from them. We will seek out information from them because we want to be more informed. That allows us to make, we hope, better investment decisions. And simply put, in jurisdictions which have a poor track record in that regard, or specific companies that have a poor track record in that regard, we will value them much less highly and are much less likely or will not invest where we think that those conditions are inappropriate. So we actually look at getting any type of information like that as being very, very helpful to allowing us to make informed and, we believe, better investment decisions. And again, I think this is something, and I encourage anybody who's interested to go to our website and read our annual report on sustainable investing. We go into quite a bit of detail on these issues. And this is really what sets a long-term investor apart from a short-term stock trader. And we are a long-term investor. Because if you're a short-term stock trader, you don't care about these issues. You buy the stock on Tuesday, you sell it on Wednesday, you buy it again on Thursday, and none of that matters. we have a buy and hold and an investment mentality, not a trading mentality. And that means that all of this stuff matters, whether it be environmental issues, whether it be carbon pricing, whether it be supply chain management, labor conditions, so on and so forth. And what we try and do is bring all of that information each and every time we make a decision. And so again, we encourage people to communicate with us because that helps us make better decisions on your behalf.
Mark Machin, I'm going to ask the next question of you. It comes from John, and he's in Victoria. He says, how are you able to protect your investment yields against the constant threat of unsteady international markets?
Okay, well, thank you, John, for the question. So I think one of the ways that we protect ourselves against unstable international markets is diversification. So we're not unduly concentrated in our investment in any one country around the world. And that allows us to not have too much risk in one particular place. So second thing is when we go in to look at a new market or look at any market, we do an enormous amount of work looking at the environment, looking at the macroeconomic environment, looking at the business environment, and looking at the opportunities in those markets. And so we thoroughly assess the environment and the risks. And then finally, when we're making particular investments in the market, in a particular company, for example, then again, we do an enormous amount of work to make sure we thoroughly understand the risks and that we're pricing them correctly, that we are being, that on your behalf, we're being compensated for those risks, and we're going to make sufficient returns for those risks in those markets. So we're very careful as we prudently invest money in different markets around the world. And again, we diversify, so we have a very broad investment spread across different markets around the world.
Great, thank you. So we have a couple of questions here that both touch on the UN and our sustainable investing, which you've talked about quite a bit now, Mark Wiseman, but I'll ask you both of these together. So the first one comes from Ian, who's watching us in Halifax. He wants to know, what is our position on the UN PRI, Principles for Responsible Investing? How important is this to us? And also Louisette, who's watching in Toronto, says the UN recognizes Indigenous rights, but many Canadian mining firms are running into issues. Can we give priority to mining that respects rights and conducts work in line with Canada's laws and U.S. Indigenous rights?
Okay, well, let me take those separately. First of all, Ian from Halifax, the UN PRI, or the UN Principles on Responsible Investing, indeed, actually, CPPIB was one of the founders of the UN PRI, and it's something that we have supported from the very outset. And this is a set of principles which suggest how institutional investors and other investors should look at factors such as environmental, social, and governance factors. Until recently, our colleague Eric Wetlaufer, who runs all of our public market investments, was on the board of the UN PRI, and indeed we are very involved and very supportive of its efforts, along with other efforts like the Carbon Disclosure Project, which again we were one of the founding members of, and I've already spoken about our role on the FSB's Climate Change Task Force. So CPPIB really believes that becoming involved and being a leader in these types of organizations is not only good for us, but in fact it's good for markets and the investment industry overall. If we can change investor behavior and create best practices, we think that that leads to more discipline in the markets, better pricing in the markets, and indeed, as the name suggests, more responsible investment. So we're highly supportive and have been from the very outset of the UNPRI, and as I say, several other leading organizations in that regard. Louisette, in terms of your question on Indigenous rights and mining companies, again, back to my previous answer, we do look at labor practices. We also do look at the rights of Indigenous peoples, be it Canadian First Nations or others, in terms of the investments that we make. It's part of the information that we would assess before making an investment in any company. And we look at that company's track record as it relates not just to the environment, not just to labor, but as you point out, also as it relates to the rights of Indigenous peoples who may be impacted by the activities of that company.
Okay. We'll take another one on climate change. Mark Wiseman, this comes from Stephen, who's watching in Toronto. He wants to know, essentially, would we consider divesting of our assets that are related to climate change, and would we publicize a policy so that we can be accountable for the results?
So, Stephen, thanks for your question. We do not believe that divestment is an appropriate approach to constructing our portfolio, and we don't think it leads to the best outcomes. So we're not in favor of divesting of any type of singular asset class or type of asset. What we do is we look at the impact of these types of issues, whether it be carbon or a company's behaviors, in terms of pricing that asset and determining whether or not it's a good one to include in part of the overall diversified portfolio of the fund. And what we've seen over time is, in fact, that divestment can lead to substantially lower returns and not necessarily the right outcomes. When I say the right outcomes, I mean the right outcomes of changing corporate behavior. Our view instead is to engage with companies as a major shareholder. As a major shareholder, that gives us the ability to engage with the companies in which we invest, to encourage them to change behaviors, to encourage them to look at environmental, social, and governance issues. And we believe if we can get those companies to change their behaviors that way, and remember, we're a big investor, so we carry a lot of weight, that will then end up holding an investment that will be more valuable in the future. And so our approach has always been one of engagement, and we think that has been a very effective approach, and that we've had actually quite an impact on improving corporate behavior as a concerned and responsible investor. We're not just seeing that in areas like climate change. We've seen it in areas like pay for performance, where we've been very, very vocal in terms of executive compensation, for example, and the way that executives get paid. And we've seen a real difference, including in the Canadian market, in that regard. The one thing we believe very, very strongly in is high quality disclosure. Because if CPPIB or any investor, particularly in public markets, wants to make an informed decision, we have to know what it is that companies are doing. All investors have to know that. And so whether it is disclosure about executive compensation, whether it is disclosure about carbon footprint, whether it is disclosure, back to Louisette's question on relationships with Indigenous peoples, we believe that public corporations need to do a better job in disclosing these risks. Because long-term investors care about these risks, not just, it's important, not just though what's in the financial statements. And so CPPIB has been very, very encouraging, including through things like the Carbon Disclosure Project and UNPRI, of pushing public corporations to do a much better job identifying these issues so that we can be an informed investor and make better decisions. But as I say, we don't believe that divestment leads to the right outcomes. In terms of disclosure, I think there's a second part to Stephen's question about disclosure. I'd encourage you to go to our website, because we disclose every single investment that we have of $1 million or more, whether that's in a public company or a private company, on our website. And that's available to all Canadians. In fact, it's available to anyone who wants to go there. So one thing that's very, very important to us, because it's not our money, it's your money, one thing that's very important to us is that all contributors and beneficiaries of the CPP understand exactly what it is we're investing in on your behalf. And so, again, we take transparency very, very seriously, and anyone can go to our website. If you have any issues finding the information, just email the address that Tara provided earlier, and we will point out how to find it.
It's contact@cppib.com. And on that note, that's a good segue into this question that comes from Marie, who's watching us in Victoria, and Jake, who's in Toronto, has a similar question, actually. Given that CPPIB invests in companies like Raytheon and Lockheed Martin, that are dependent on war for revenue, do CPP decision makers think that investing in these companies on behalf of, and this is from Marie, says, on behalf of me and other Canadians, is a good idea?
Well, again, we look into all factors in making any given investment. The one thing that we don't do is we will not invest in companies where it is illegal for Canadians to invest in. And so that's one bright line we obviously have. Since we're investing Canadians' money, we follow the same rules. If you're not permitted to invest, we're not permitted to invest. So, for example, we don't invest in Zimbabwe, where there is a restriction due to sanctions of Canadian investors investing in Zimbabwe. Similarly, cluster munitions. There is because Canada is part of the Montreal Protocol, Canada does not, Canadians are not permitted to invest in cluster munitions. We don't invest in companies that are involved in the manufacture of cluster munitions. So we do have that restriction, and then beyond that, we look at all the factors that go into the long-term value of an investment through the same integration process I talked about earlier as it relates to all factors, including environmental, social, and governance factors.
Okay, great. Next question comes from Josh. He's watching us online. He says, which asset classes do you see the most opportunities for at the moment? And are there any areas of your portfolio that you're currently actively building out? For Mark Wiseman again.
Josh, is it?
Josh, yes.
Hi, Josh. Thanks for that question. In terms of asset classes, today we generally invest across a highly diversified set of asset classes, but we do put focus on certain areas at certain times. I'll pick one. You asked about areas that we're interested in terms of positively inclined towards. One area that we're spending a lot more time on is investments related to agriculture. We see a large, again, long-term benefit to the changes that are taking place in the agriculture industry, both technological change in terms of more robust, more sustainable, more effective farming methods, and also changes related to the way that the global population is sustaining itself. So one area that has shown itself in our portfolio is not just in farmland, but you would have seen the recent transaction that we announced. We haven't yet closed it, investing in 40% of Glencore's agricultural business, which is involved in the shipping and movement of grains and pulses and things like that. Again, we see that as a long-term value creation opportunity. In fact, that investment includes the purchase of many of the old Viterra assets, which if you go back in time were actually some of the old Saskatchewan wheat pool assets. And we think those types of investments, again, if you take that long-term view, not looking at where we are in the commodity cycle, but looking at what are the demographic shifts taking place in the world, what are the changes taking place in the way that, frankly, the human race sustains itself, we see that as an area that is going to create long-term value, and we're sort of at the bottom of the commodity cycle, and that means that's a good time for a long-term investor to make that type of investment. Beyond that, in terms of where there are risks today, again, we're paying attention. We're paying attention to the energy sector. Obviously, we've all seen, and all of us in Canada have experienced the volatility in the energy sector. That's both a risk and an opportunity that we're paying attention to. And similarly, I think we're watching our real estate portfolio very carefully. Our portfolio isn't in residential real estate like your house or my house, but it's subject to some of the same types of pressures from low interest rates and potentially a rising interest rate environment. So we're being quite cautious these days on our real estate, which tends to actually be three types of real estate. Commercial real estate, things like office buildings, retail, shopping malls, and then logistics properties, so things like warehouses and logistics facilities. And again, the Canadian market is a microcosm of it, but we are being particularly cautious in this interest rate environment in terms of looking at our real estate portfolio.
Okay, and we only have a few minutes left, so I think this might have to be our final question. It comes from Trevor. He's watching us online. From Mark Wiseman, how come there was a decision to have a small allocation to Canadian equities despite being called the Canada Pension Plan? How do you determine your country allocations?
Trevor, that's a great question. I should start by saying that in fact 19% of the CPPIB portfolio is invested in Canada between both equities, private investments like real estate and infrastructure, and government bonds. Canada actually only represents about 3% of the world's investable market. And so, in fact, we are probably somewhere around 6+ times overweight to Canada. We like that. We want to be overweight to Canada. We will always be overweight to Canada because it's our home market. We understand it well. We think the rule of law in Canada, the transparency of Canadian capital markets, and frankly, because we're located here and allows us to know more about what's going on in this country, means that Canada will always be our first choice in terms of a destination of where to invest. Having said that, managing a fund today that is in excess of $278 billion at year end means that we have to diversify the portfolio around the world. If we put all of your money just in Canada, we would be overexposed to the risk of the Canadian markets. If the Canadian markets went down, the fund would go down disproportionately. So through diversification and investing around the world, most notably in the United States, which is our biggest destination for investment, in Western Europe, and then increasingly in growth markets like China and India, we create an overall diversified portfolio where if any one economy goes down, it's offset by the increase in other economies. And that diversification is really, really important to protect the fund in the downside. And we saw that in our last fiscal year. In our last fiscal year, the 12-month period ended March 31st, the TSX was down somewhere around 8 or 9%. Our portfolio was in fact up 3.4% over that same period of time. And that's the benefit of diversification. While our Canadian investments went down, we benefited from our global investments going up, including from the fact that many of our investments are denominated in currencies other than Canadian dollars. So that's what gives us a long-term risk-adjusted rate of return. And again, we like investing in Canada. We think this is the premier destination to invest, but it wouldn't be prudent to put all of our eggs, all of your eggs, in just one basket.
Okay, that's great. So that's all the time that we have for our webcast today. If you're at one of our 9 public meeting sites, one of our senior executives is available at the front of the room. And as a reminder, we're going to answer any questions that we didn't get to today in writing in the next few days, as long as you've included your contact information along with your question. You can reach us anytime at contact@cppib.com. Thank you for taking the time to be a part of our public meetings today.